Speak. Mayuresh Joshi from Angel Broking joins in on the show right now. Mayuresh, would you say that this flip-flop in the market is going to continue and maybe the recovery that we've seen for the last 10 days in the broader markets may not be it and we could be back to weakness perhaps?
Afternoon, Ash. I think that is quite a possibility, and in our opinion, what you've probably seen specifically from Q4 earnings relatively for the entire universe has been relatively soft, though there have been a few outliers within the mid-cap universe. But what you probably witnessed within the mid and the small cap space as well, and the kind of stock falls, I think the markets, in our opinion, probably locked in a range. Not expecting a huge correction, but the volatility, as you rightly pointed out, can very well continue. I think the next few weeks, as Q1 earnings will start trickling in, you might see the bottoming out actually happening in qualitative mid-caps, which have substantially. So as the earnings calendar once again is constrained in the range at this point of time, we're not expecting a sharp correction. So I think qualitative names within the large and mid-cap universe on any decline over the next few weeks is something that I would probably recommend.
Mayuresh, how are you looking at the pharma trade? Double-digit, near 20% gains in the last 7 sessions for all of the index pharma stocks. That's no mean feat, given the fact that these stocks have had forever of underperformance.
Afternoon, Tanveer. So I think that's become a consensus call at this point of time. But there have been a spate of good news which are probably abetting the earnings review for a lot of the stocks within this sector over the next 2 to 3 years. So a few companies like Sun, where the management had already indicated that the second half of this fiscal you'll probably see a double-digit growth, and what you probably witnessed with the EIR coming through, that is good news in terms of what the specialty pipeline business for Sun, specifically in terms of QE drugs like Ionsa, Bromside, Sequeira, can actually do to the revenues FY20 onwards. Again, I think the launch that you probably have seen from Dr. Reddy's, I think it's a substantial one in terms of upping up their earnings estimates for FY20 as well. But there are a lot of pharma companies where I think the specialty pipeline looks extremely strong. So I think the pricing pressures that the industry had faced over the last few quarters and years, I think somewhere the bottoming out should start taking place. The kind of underperformance was also due to the fact that FDA-affected plants were not allowing this pipeline to probably come through. And again, the pricing pressures generally had earnings cuts across the board. So as these specialty drugs start getting monetized over the next few quarters, you have some respite on the pricing front because of this factor. And the other element in terms of the elevated R&D expenses which plague their P&Ls, I think the R&D expenses will still continue, but because of monetization happening as these drugs start coming through their launch stages, that's going to clearly get an offset effect. So earnings probably for FY19 largely captured in the prices, but if somebody has a view over the next 2.5 years, selectively pharma looks pretty attractive. And there are painful points as well, because a lot of investors are probably holding on to large cap names where the prices have still not recovered from the prices that we had witnessed 2 to 3 years back. So this is not the time to probably look at exiting pharma stocks because near-term valuations are rich. I think investors who had probably held these stocks for a length of time should continue holding. If they decline, yes, I think qualitative names can probably be added on declines in a staggered way.
Mayuresh, very quickly from the insurance space, what is it that you're advocating?
So the space is very interesting, Tanveer, but again, if you have a comparative check between the 3 players, HDFC Life on the life insurance part, ICICI Pru and SBI Life, I think HDFC Life's dynamics in this current scenario look far more attractive. If you look at their protection business, it's almost 11% of the overall pie. ULIPs is almost 57%. If you look at the return on embedded value, that is close to 22%. ICICI Pru is around 23.2%. And in comparison to the value of new business margins, they are comparatively higher. So it's around 22.5% for HDFC Life compared to an ICICI Pru which is around 14.5%. SBI Life, which stacks up at 16.5%. So I think the value of new business has grown substantially. The other parameters probably remain quite similar in terms of the solvency ratios and the persistency ratios for all three players. So the return on embedded value probably is very high for HDFC Life at this point of time at 4.5 times compared to 2.8 for both ICICI and SBI Life. But I think the valuation premium in terms of the protection business having gained significantly, and there again I think the margin contribution sustaining along with a lot of bancassurance partners getting added on is obviously going to be a key focal point for HDFC Life. The FTSE rebalancing also probably abets the kind of perception that HDFC Life might have in terms of foreign holdings as well. So though the valuations are a little bit on the higher side, I think I'll still stick around with HDFC Life for a medium-term perspective.
Thanks for that, Mayuresh. I can see.
Chatting about TCS before the buyback as well got announced. The fact that it's again a 15% premium, the quantum of course is not coming in as a surprise, just gives you the kind of conviction and the confidence that the management has in this current environment. I mean, the naysayers, the skeptics, all shut up, because this clearly indicates the kind of confidence the management has in the order pipeline, the booking size, momentum in both the digital as well as the BFSI segment.
No, absolutely. So again, Aisha, I think if you look at the premium, I think it's a tad bit more than what we had expected. But a large element in terms of the revival in their sub-segments is clearly getting vindicated over the last few quarters. So I think except BFSI, where I think the commentaries were a little bit on the softer side, I think the expectations largely on the retail side of the business has been very, very robust. Even Diligenta and their insurance piece is coming together, and again the digital investments that they've done, that has started bearing fruit. So I think 26%, 27% of the overall top line comes through from the digital business. The EBIT margins are far better than most of their peers, 26-28%. I think the confidence in terms of maintaining those margins even at the lower end is similarly better to what a lot of peers would have done. Having said that, again, I think the expectations from BFSI, which contributes 31% in terms of a sector contribution to the top line, if that starts showing signs of super recovery over the next few quarters, I think the earnings estimates can be upgraded significantly for TCS. And again, there are no complaints in terms of what they're probably doing, both in terms of buyback, dividends, or even the return on equity at 29-30% that they post. So the business model is right. I think the premium, again, I think what they've announced, a tad bit more than what we were expecting. But yes, I think the business model and the confidence that the management has put forth, I think that should put the company in good stead, not just for the next few quarters, for the next few years as well.